Question 1. The audit findings indicate that the firm's current big data analytics framework for risk assessment may not adequately address emerging regulatory concerns around algorithmic bias and data privacy. Which of the following approaches best represents a proactive and compliant response to these findings? Option A. Continue to leverage existing big data analytics tools for efficiency gains, assuming that current regulations are sufficient and that specific mandates for algorithmic bias and enhanced data privacy in analytics are unlikely to be implemented in the near future. Option B. Implement a superficial review of data sources to ensure basic compliance with existing data protection laws, without undertaking a deeper analysis of the algorithmic decision-making processes or potential for bias. Option C. Prioritize the exploration of new, cutting-edge big data analytics technologies to maintain a competitive edge, deferring any significant changes to the current framework until explicit regulatory penalties are imposed. Option D. Conduct a comprehensive review of the big data analytics framework, focusing on identifying and mitigating potential risks related to data bias, algorithmic transparency, and customer data protection, and develop enhanced governance and oversight mechanisms. The correct answer is D. Conduct a comprehensive review of the big data analytics framework, focusing on identifying and mitigating potential risks related to data bias, algorithmic transparency, and customer data protection, and develop enhanced governance and oversight mechanisms. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the potential benefits of advanced analytics with the imperative to comply with evolving regulatory expectations regarding data privacy and ethical use of AI in insurance. The audit findings highlight a potential gap between the firm's current practices and the anticipated regulatory scrutiny, necessitating a proactive and informed response. The complexity arises from the nascent stage of many big data analytics applications in insurance and the lack of definitive, prescriptive guidance in some areas, demanding careful interpretation of existing principles and foresight into future regulatory trends. Correct approach analysis. The correct approach involves a comprehensive review of the firm's big data analytics framework, focusing on identifying and mitigating potential risks related to data bias, algorithmic transparency, and customer data protection. This approach aligns with the overarching principles of responsible innovation and regulatory compliance. Specifically, it necessitates a deep dive into the data sources, model development processes, and deployment strategies to ensure they adhere to principles of fairness, accountability, and transparency, which are increasingly emphasized by regulators. This proactive risk assessment and mitigation strategy is crucial for demonstrating due diligence and maintaining customer trust, thereby aligning with the spirit and likely intent of future regulatory frameworks governing AI and big data in insurance. Incorrect approach is analysis. An approach that focuses solely on the technical capabilities of the big data analytics tools without considering their ethical implications or regulatory compliance would be professionally unacceptable. This overlooks the fundamental responsibility of insurers to use data and advanced analytics in a manner that is fair, non-discriminatory, and respects customer privacy. Such an approach risks violating data protection laws and ethical guidelines, leading to reputational damage and regulatory penalties. Another incorrect approach would be to dismiss the audit findings as merely a suggestion without concrete regulatory mandates. This demonstrates a lack of foresight and a failure to engage with emerging best practices and potential future regulatory directions. Regulators often signal their expectations through guidance and enforcement actions, and ignoring these signals can lead to significant compliance issues when regulations do materialize. Finally, an approach that prioritizes the immediate cost savings or efficiency gains from big data analytics over robust governance and risk management would be flawed. While efficiency is a business objective, it cannot come at the expense of regulatory adherence and ethical conduct. This approach neglects the long-term risks associated with unchecked data use and algorithmic decision-making, which can have severe financial and reputational consequences. Professional reasoning. Professionals in the big data analytics and insurance space must adopt a proactive and principle-based approach to regulatory compliance and ethical considerations. This involves 1. Understanding the current regulatory landscape and anticipating future trends. 2. Conducting thorough risk assessments of all big data analytics initiatives, including potential biases, privacy concerns, and transparency issues. 3. Developing and implementing robust governance frameworks for data management and algorithmic decision-making. 4. Fostering a culture of ethical data use and continuous learning within the organization. 5. Engaging with regulators and industry bodies to stay abreast of evolving expectations. This systematic approach ensures that innovation in big data analytics is pursued responsibly and sustainably, safeguarding both the firm and its customers. Question 2. Investigation of a new insurance company's proposal to use a sophisticated machine learning model for underwriting auto insurance policies. The model, trained on a vast dataset, aims to predict accident likelihood with high accuracy. However, preliminary internal reviews suggest that while the model's overall predictive power is excellent, certain demographic groups appear to be consistently assigned higher risk scores, potentially leading to higher premiums or denial of coverage, even when controlling for traditional risk factors. The company is seeking to understand the most ethically and regulatorily sound approach to address this potential issue before deploying the model. Option A. Focus on the interpretability of the chosen machine learning algorithm, such as a simple linear regression, even if it means sacrificing some predictive accuracy, to ensure that the underwriting decisions can be easily explained and justified. Option B. Discontinue the use of machine learning for underwriting altogether and revert to traditional actuarial methods, as the complexity of advanced algorithms introduces an unacceptable level of risk regarding potential discrimination. Option C. Conduct a thorough audit of the model's outputs, specifically examining performance and outcomes across various demographic segments. If disparities are identified, implement bias mitigation techniques to adjust the model's predictions or the features it uses, and document these steps rigorously. Option D. Prioritize the model's predictive accuracy by fine-tuning its parameters to achieve the highest possible overall performance, assuming that any observed disparities are purely a reflection of genuine, albeit complex, risk differences. The correct answer is D. Prioritize the model's predictive accuracy by fine-tuning its parameters to achieve the highest possible overall performance, assuming that any observed disparities are purely a reflection of genuine, albeit complex, risk differences. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging advanced analytics for risk assessment and the ethical imperative to ensure fairness and prevent discrimination. The use of machine learning algorithms, particularly in insurance underwriting, necessitates a careful balance between predictive accuracy and adherence to regulatory principles designed to protect consumers. The complexity arises from the potential for algorithms to inadvertently perpetuate or even amplify existing societal biases, leading to disparate outcomes for protected groups, even if such intent is absent. Careful judgment is required to identify and mitigate these risks. The correct approach involves a proactive and transparent process of bias detection and mitigation within the machine learning model development and deployment lifecycle. This includes rigorous testing of the model's performance across different demographic segments, understanding the drivers of its predictions, and implementing techniques to reduce or eliminate unfair bias. This approach aligns with the fundamental principles of fairness and non-discrimination enshrined in insurance regulations, which aim to ensure that individuals are not unfairly disadvantaged based on characteristics unrelated to their risk profile. Regulatory frameworks often require insurers to demonstrate that their underwriting practices are actuarially sound and do not result in unfair discrimination. An incorrect approach would be to solely focus on maximizing predictive accuracy without considering the fairness implications of the chosen machine learning algorithm. For instance, deploying a complex supervised learning model like a support vector machine, SVM, without scrutinizing its outputs for disparate impact on protected groups would be ethically and regulatorily unsound. Its failure to address potential bias could lead to discriminatory pricing or coverage decisions, violating consumer protection laws and ethical standards. Another incorrect approach would be to rely on unsupervised learning techniques like k-means clustering, without a clear understanding of how the resulting clusters might correlate with protected characteristics, potentially leading to unintended discriminatory outcomes. Similarly, using decision trees without carefully examining the features used for splitting and their potential for proxy discrimination would be a failure. The professional decision-making process for similar situations should involve a multi-stage approach. Firstly, clearly define the objectives of the machine learning model and the acceptable thresholds for predictive accuracy and fairness. Secondly, select appropriate algorithms, considering their interpretability and known biases. Thirdly, implement robust data preprocessing techniques to identify and address potential sources of bias in the training data. Fourthly, conduct thorough model validation, including fairness metrics and subgroup analysis, to detect and quantify any disparate impact. Fifthly, develop and implement mitigation strategies if bias is detected, such as algorithmic adjustments or policy changes. Finally, maintain ongoing monitoring and auditing of the model's performance in production to ensure continued fairness and compliance. Question 3. The evaluation methodology shows that the insurance company is considering adopting advanced big data technologies, including distributed computing frameworks and machine learning algorithms, to enhance its underwriting and claims processing. However, the internal audit team has raised concerns about the potential for these technologies to create new regulatory compliance challenges. Which of the following approaches best addresses these concerns while enabling the company to leverage big data analytics responsibly? Option A. Prioritize the development and deployment of advanced analytical models using the most sophisticated big data technologies available, with a plan to address regulatory compliance issues retrospectively as they arise. Option B. Implement a phased approach to big data adoption, starting with robust data governance, privacy impact assessments, and the development of explainable models before scaling to more complex analytical applications. Option C. Rely heavily on third-party data providers and pre-built analytical solutions, assuming their compliance with regulatory standards without independent verification. Option D. Focus exclusively on internal data sources and traditional analytical methods to avoid the complexities and potential regulatory pitfalls associated with external data and advanced big data technologies. The correct answer is A. Prioritize the development and deployment of advanced analytical models using the most sophisticated big data technologies available, with a plan to address regulatory compliance issues retrospectively as they arise. Explanation. This scenario is professionally challenging because it requires balancing the potential benefits of advanced big data technologies for risk assessment and insurance product development against the stringent regulatory requirements for data handling, privacy, and model explainability within the specified jurisdiction. The pressure to innovate and gain a competitive edge through big data analytics must be tempered by a thorough understanding of and adherence to the applicable regulatory framework. The correct approach involves a phased implementation strategy that prioritizes data governance, security, and compliance from the outset. This includes establishing clear data lineage, implementing robust access controls, ensuring data anonymization or pseudonymization where appropriate, and developing models that can be validated and explained to regulators. This aligns with the core principles of data protection and responsible innovation mandated by the regulatory framework, which emphasizes consumer trust and fair treatment. An incorrect approach that focuses solely on rapid deployment of cutting-edge big data technologies without adequate consideration for regulatory compliance risks significant penalties and reputational damage. Specifically, adopting a move fast and break things mentality, where data privacy and security are treated as afterthoughts, directly contravenes data protection laws that mandate specific safeguards for personal and sensitive data. Furthermore, implementing complex, opaque big data models without a clear strategy for explainability and validation would likely fail to meet regulatory expectations for model risk management and fair outcomes, potentially leading to accusations of unfair discrimination or arbitrary decision-making. Another incorrect approach, which involves relying on third-party data sources without thorough due diligence on their compliance with data protection standards, exposes the organization to risks associated with data breaches or misuse originating from those sources, thereby failing to uphold the organization's own regulatory obligations. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the regulatory landscape. This involves proactively identifying all relevant laws and guidelines pertaining to data analytics, privacy, and insurance. Subsequently, a risk-based approach should be employed, where potential implementation strategies are evaluated not only for their technical feasibility and business value, but also for their compliance implications. This includes conducting thorough data privacy impact assessments, developing robust data governance policies, and investing in explainable AI (XI) techniques where necessary. Continuous monitoring and auditing of data processes and model performance against regulatory requirements are also crucial components of this framework. Question 4. The control framework reveals that the insurance firm has recently implemented a sophisticated anomaly detection model to identify potentially fraudulent claims. However, the model was deployed directly into production without a comprehensive review of its potential biases or independent validation against regulatory fairness standards. Which of the following represents the most professionally responsible course of action to address this control gap? Option A. Document the model's implementation and plan for a post-deployment audit to assess its impact on fairness and compliance. Option B. Immediately halt the use of the anomaly detection model and initiate a thorough bias assessment and regulatory compliance review before any further deployment. Option C. Proceed with the model's use, but implement a manual override system for flagged claims to mitigate potential unfairness. Option D. Focus on optimizing the model's performance metrics, assuming that improved accuracy will inherently lead to fairer outcomes. Correct answer is B. Immediately halt the use of the anomaly detection model and initiate a thorough bias assessment and regulatory compliance review before any further deployment. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between leveraging advanced data mining techniques for risk assessment and the stringent regulatory requirements for data privacy and fair treatment in the insurance sector. The firm's reliance on a new, sophisticated anomaly detection model, while potentially improving risk identification, introduces a significant risk of bias or unfair discrimination if not rigorously validated against regulatory standards. The challenge lies in balancing innovation with compliance, ensuring that the pursuit of analytical insights does not inadvertently lead to breaches of data protection laws or principles of equitable risk pricing. Professional judgment is required to navigate the complex interplay of technical capabilities, ethical considerations, and legal obligations. Correct approach analysis. The correct approach involves a multifaceted validation process that prioritizes regulatory compliance and ethical considerations. This begins with a thorough review of the anomaly detection model's underlying logic and data inputs to identify potential sources of bias. It then necessitates rigorous testing against established fairness metrics and regulatory guidelines, such as those pertaining to unfair discrimination and data privacy. This includes ensuring that the model does not disproportionately flag individuals from protected characteristics or use sensitive data inappropriately. Furthermore, the approach mandates clear documentation of the model's development, validation, and ongoing monitoring processes, providing transparency and accountability. This aligns with the principles of responsible AI and data governance, ensuring that the use of big data analytics in risk and insurance is both effective and compliant with the relevant regulatory framework. Incorrect approaches analysis. Implementing the anomaly detection model without independent validation and bias assessment represents a significant regulatory failure. This approach ignores the potential for algorithmic bias, which could lead to discriminatory pricing or underwriting practices, violating principles of fairness and potentially specific provisions against unfair discrimination in insurance. Relying solely on the model's perceived technical sophistication without empirical evidence of its fairness and compliance is a direct contravention of the duty of care and due diligence expected of regulated entities. Using the anomaly detection model to identify high-risk individuals for immediate premium increases without a transparent and justifiable methodology is also a regulatory failure. This approach bypasses the need for a clear, explainable, non-discriminatory basis for risk assessment. It risks creating a black box system where decisions are made without adequate oversight or recourse for the insured, potentially violating principles of transparency and consumer protection. Deploying the anomaly detection model solely for internal efficiency gains without considering its impact on customer fairness or regulatory adherence is another critical failure. While efficiency is a business objective, it cannot supersede legal and ethical obligations. This approach demonstrates a disregard for the broader implications of data analytics on consumer rights and fair market practices, which are central to the regulatory framework governing the insurance industry. Professional reasoning. Professionals in this domain must adopt a risk-based approach to the implementation of big data analytics. This involves proactively identifying potential regulatory and ethical risks associated with each data mining technique. A robust control framework should mandate a phased implementation process, starting with thorough data governance, model validation, and bias assessment before full deployment. Transparency, explainability, and continuous monitoring are paramount. Professionals should always prioritize adherence to the specific regulatory framework governing their jurisdiction, ensuring that any analytical innovation serves to enhance risk management without compromising fairness, privacy, or consumer protection. A culture of ethical data use and regulatory awareness is essential for navigating the complexities of big data in insurance. Question 5. The review process indicates that a new big data analytics initiative is proposing to use a complex, multivariate probability distribution to model the likelihood of catastrophic events for a portfolio of insurance policies. While the underlying data is extensive, the specific parameters of this distribution have been derived primarily through machine learning algorithms, without extensive backtesting against historical claims data, or a clear articulation of the assumptions underpinning its application to this specific risk profile. Furthermore, the proposed model relies heavily on conditional probabilities derived from these algorithms to adjust risk factors for individual policyholders. But the interpretability of these conditional relationships is limited, which approach best aligns with regulatory expectations for the use of advanced analytics in risk and insurance. Option A. Prioritize the use of simpler, more traditional probability models that are well understood and easily explainable to regulators, even if they offer less granular risk segmentation. Option B. Focus on the volume and variety of the big data used, assuming that the inherent complexity of the data will automatically lead to a more accurate and compliant risk assessment, regardless of the specific statistical methods employed. Option C. Proceed with the proposed model, emphasizing its novelty and potential for enhanced predictive accuracy, and address any regulatory queries regarding validation and interpretability as they arise. Option D. Conduct a comprehensive validation of the chosen probability distribution and its parameters using historical data and expert judgment. Clearly document all assumptions and limitations, and provide a transparent explanation of how conditional probabilities are derived and applied, ensuring alignment with regulatory principles of sound actuarial practice and model governance. The correct answer is C. Proceed with the proposed model, emphasizing its novelty and potential for enhanced predictive accuracy, and address any regulatory queries regarding validation and interpretability as they arise. Explanation. This scenario presents a professional challenge because it requires actuaries to balance the innovative application of advanced statistical techniques with the stringent regulatory requirements governing the use of data and model outputs in the insurance industry. The core difficulty lies in ensuring that the theoretical elegance of probability distributions and conditional probability, particularly when applied through complex models, translates into practical, justifiable, and compliant risk assessments. The pressure to leverage big data for competitive advantage must be tempered by a rigorous understanding of the underlying assumptions, limitations, and potential biases inherent in these analytical methods, and how these interact with regulatory expectations for transparency and fairness. The correct approach involves a thorough validation of the chosen probability distribution and its parameters against historical data and expert judgment, coupled with a clear articulation of the model's assumptions and limitations. This aligns with regulatory frameworks that mandate sound actuarial principles and robust model governance. Specifically, it addresses the need for actuaries to demonstrate that their models are fit for purpose, accurately reflect underlying risks, and do not lead to discriminatory outcomes. The use of conditional probability and Bayes' theorem in this context, when properly validated and explained, allows for more nuanced risk assessment, but the validation process itself is paramount to regulatory compliance. This approach ensures that the insights derived from big data analytics are not only statistically sound, but also ethically defensible and legally compliant, fostering trust and stability in the insurance market. An incorrect approach would be to implement a sophisticated probability distribution or a complex application of conditional probability without adequate validation. This failure to validate the model's assumptions and parameters against empirical evidence and regulatory standards creates significant ethical and regulatory risks, could lead to mispriced products, inadequate reserves, or unfair treatment of policyholders, all of which are grounds for regulatory censure. Another incorrect approach is to over-rely on the perceived objectivity of big data analytics without critically assessing the potential for bias within the data or the model itself. This can result in models that perpetuate or even amplify existing societal biases, leading to discriminatory pricing or underwriting practices, which directly contravenes principles of fairness and equal treatment mandated by regulators. A third incorrect approach is to present the outputs of complex stochastic processes without a clear explanation of the underlying methodology, assumptions, and inherent uncertainties. This lack of transparency hinders effective oversight by both management and regulators, and prevents stakeholders from understanding the basis of risk assessment. Professionals should adopt a decision-making process that prioritizes a robust understanding of both the analytical techniques and the regulatory landscape. This involves a continuous cycle of model development, validation, and monitoring, with a strong emphasis on documentation and clear communication of assumptions and limitations. When employing advanced probability theory, actuaries must be able to justify their choices of distributions and parameters, demonstrate the model's predictive power, and assess its sensitivity to changes in input data or assumptions. Furthermore, they must proactively identify and mitigate potential biases, ensuring that their analytical outputs are fair and equitable. This proactive, transparent, and validation-centric approach is essential for navigating the complexities of big data analytics in a regulated environment. Question 6. Process analysis reveals that a leading insurance company is rapidly expanding its use of big data analytics to refine risk assessment models and personalize customer offerings. However, the internal data science team has raised concerns about the potential for algorithmic bias and the lack of a clear framework for managing customer data privacy and consent in the context of these new analytical capabilities. Companies' executive leadership is pushing for faster implementation to gain a competitive edge. Which of the following approaches best addresses this implementation challenge, while adhering to regulatory expectations for data governance and ethical analytics in the insurance sector? Option A. Prioritize the immediate deployment of advanced analytics tools to capture market share, with a plan to address data governance and ethical concerns retrospectively as they arise. Option B. Implement a comprehensive data governance framework that includes explicit ethical guidelines, data privacy protocols, and a mandatory privacy impact assessment process for all new big data analytics projects before deployment. Option C. Focus exclusively on enhancing the technical accuracy and completeness of the data used for analytics, assuming that high-quality data will inherently lead to ethical outcomes. Option D. Delegate the responsibility for ethical considerations solely to the data science team, expecting them to identify and resolve any issues independently without formal oversight or established policies. The correct answer is B. Implement a comprehensive data governance framework that includes explicit ethical guidelines, data privacy protocols, and a mandatory privacy impact assessment process for all new big data analytics projects before deployment. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of advanced analytical capabilities with stringent data governance and ethical obligations, particularly within the context of risk and insurance. The pressure to leverage big data for competitive advantage can inadvertently lead to overlooking critical compliance and ethical considerations, creating a significant risk of regulatory breaches and reputational damage. Careful judgment is required to ensure that innovation does not outpace responsible data handling practices. The correct approach involves establishing a robust data governance framework that explicitly incorporates ethical guidelines and regulatory compliance from the outset of any big data analytics initiative. This includes defining clear data ownership, access controls, data quality standards, and a comprehensive privacy impact assessment process. Specifically, this approach aligns with the principles of responsible data use, emphasizing transparency, fairness, and accountability, which are foundational to maintaining customer trust and adhering to regulatory expectations for data protection and fair treatment in insurance. The regulatory framework for big data analytics in risk and insurance mandates that firms understand and manage the risks associated with data, including ethical risks and compliance with data protection laws. An incorrect approach that prioritizes immediate deployment of analytics tools without adequate data governance oversight fails to address the inherent risks. This can lead to unauthorized data access, biased algorithm development, and potential breaches of customer privacy, directly contravening regulatory requirements for data security and fair processing. Another incorrect approach that focuses solely on technical data quality metrics, such as accuracy and completeness, while neglecting ethical considerations and potential for discriminatory outcomes, is also professionally unacceptable. While data quality is crucial, it is insufficient on its own. Ethical implications, such as whether the data, even if accurate, could lead to unfair pricing or underwriting decisions based on protected characteristics, must be proactively assessed. This oversight can result in regulatory penalties for unfair discrimination and a loss of public confidence. A further incorrect approach that relies on post hoc ethical reviews after analytics models have been developed and deployed is reactive rather than proactive. This approach misses opportunities to embed ethical considerations into the design and development phases, increasing the likelihood of unintended negative consequences and making remediation more complex and costly. It also fails to meet the proactive risk management expectations of regulators. The professional decision-making process for similar situations should involve a multi-stakeholder approach, bringing together data scientists, compliance officers, legal counsel, and business leaders. This team should collaboratively define ethical principles and data governance policies that are integrated into the entire data analytics lifecycle, from data acquisition and processing to model deployment and ongoing monitoring. Regular training and awareness programs for all personnel involved in data analytics are essential to foster a culture of ethical data stewardship and regulatory compliance. A continuous feedback loop for reviewing and updating these policies in response to evolving technologies and regulatory landscapes is also critical. Question 7. Assessment of how an insurance company's risk management department should approach the identification and mitigation of operational risks arising from the implementation of a new big data analytics platform for underwriting, considering the need to comply with relevant regulatory frameworks and ethical data handling principles. Option A. Delegate the entire responsibility for identifying and mitigating operational risks to the IT department, trusting their technical expertise to manage all platform-related risks. Option B. Prioritize the rapid deployment of advanced analytical models to identify underwriting inefficiencies, with post-deployment reviews to address any identified operational risks and compliance gaps. Option C. Focus primarily on the technical security of the big data platform, assuming that robust cybersecurity measures will inherently mitigate most operational risks, and conduct limited stakeholder consultations. Option D. Establish a cross-functional working group comprising data scientists, risk managers, compliance officers, legal counsel, and business unit representatives to collaboratively define data governance policies, assess potential biases in data and models, and develop integrated mitigation strategies for identified operational risks. The correct answer is B. Prioritize the rapid deployment of advanced analytical models to identify underwriting inefficiencies, with post-deployment reviews to address any identified operational risks and compliance gaps. Explanation: this scenario is professionally challenging because it requires balancing the potential benefits of advanced analytics in operational risk management with the stringent regulatory obligations and ethical considerations surrounding data privacy and security. The exam's focus on big data analytics for risk and insurance implies a need to understand how these technologies are applied within a regulated environment, specifically concerning operational risks. Professionals must navigate the complexities of identifying, assessing, and mitigating these risks while adhering to the principles of data integrity, fairness, and transparency, all within the confines of the specified regulatory framework. The correct approach involves a comprehensive, multi-stakeholder engagement strategy that prioritizes data governance and ethical considerations alongside analytical rigor. This approach recognizes that operational risks in big data analytics are not solely technical, but also involve human factors, process design, and regulatory compliance. By involving all relevant stakeholders, including data scientists, risk managers, compliance officers, and business leaders, the organization can ensure that the identification and mitigation of operational risks are holistic and aligned with both business objectives and regulatory mandates. This aligns with the overarching principles of responsible data use and robust risk management frameworks expected within the insurance and risk sector. An incorrect approach that focuses solely on the technical capabilities of big data tools without adequate consideration for data governance and regulatory compliance fails to address the full spectrum of operational risks. This could lead to breaches of data privacy regulations, inadequate risk mitigation strategies, and potential reputational damage. For instance, an approach that prioritizes speed of analysis over data validation and bias detection might overlook critical operational risks embedded in the data itself or in the analytical models, leading to flawed risk assessments and ineffective mitigation. Another incorrect approach that neglects the input and oversight of compliance and legal teams risks overlooking specific regulatory requirements related to data handling, model explainability, and the reporting of operational incidents. This can result in non-compliance, fines, and legal challenges. Similarly, an approach that excludes business unit leaders from the process may fail to identify operational risks that are specific to their day-to-day activities, or to implement mitigation strategies that are practical and sustainable within their operational context. The professional decision-making process for similar situations should involve a structured risk assessment framework that explicitly incorporates data governance, ethical considerations, and regulatory compliance from the outset. This includes establishing clear data handling policies, conducting thorough impact assessments for new analytical initiatives, and ensuring continuous monitoring and auditing of data processes and analytical models. Professionals should adopt a proactive stance, seeking to anticipate potential operational risks and embedding mitigation strategies into the design and implementation phases of big data analytics projects, rather than treating them as an afterthought. Question 8. Upon reviewing the firm's proposal to utilize advanced machine learning algorithms to analyze vast datasets of customer behavior, policy claims history, and external demographic information for enhanced underwriting and fraud detection, the Chief Data Officer has raised concerns about potential GDPR implications. The proposal outlines the use of pseudonymized data for model training and validation. What is the most appropriate next step to ensure regulatory compliance? Option A. Obtain explicit consent from all customers whose data will be used in the analysis, even if the data is pseudonymized, to ensure full transparency. Option B. Conduct a comprehensive data protection impact assessment (DPIA) to evaluate the risks to data subjects' rights and freedoms associated with the proposed processing activities, and to identify appropriate mitigation measures. Option C. Focus solely on strengthening the firm's cybersecurity infrastructure to prevent any potential data breaches, assuming this addresses the core of GDPR compliance for big data analytics. Option D. Immediately proceed with the data analysis, as pseudonymization is generally considered sufficient protection under GDPR for analytical purposes. The correct answer is D. Immediately proceed with the data analysis, as pseudonymization is generally considered sufficient protection under GDPR for analytical purposes. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging advanced big data analytics for risk assessment and the stringent regulatory requirements for data privacy and security, particularly within the context of insurance. The firm's ambition to enhance underwriting accuracy through granular customer data must be balanced against its legal and ethical obligations to protect that data. Careful judgment is required to ensure that the pursuit of analytical insights does not lead to regulatory breaches or erosion of customer trust. The correct approach involves a proactive and comprehensive data governance framework that integrates regulatory compliance from the outset of any big data analytics initiative. This means establishing clear data anonymization and pseudonymization protocols, conducting thorough data protection impact assessments, DPIA, before deploying new analytical models, and ensuring robust consent management mechanisms are in place. Specifically, adherence to GDPR principles such as data minimization, purpose limitation, and accountability is paramount. This approach is correct because it directly addresses the core requirements of GDPR, ensuring that personal data is processed lawfully, fairly, and transparently, with appropriate safeguards. It demonstrates a commitment to responsible data handling and risk mitigation, aligning with the regulatory expectation for firms to embed compliance into their operational processes. An incorrect approach would be to proceed with the advanced analytics without first conducting a DPIA. This failure to assess the potential risks to data, subjects' rights and freedoms before processing sensitive data is a direct contravention of GDPR Article 35. It signifies a reactive rather than proactive stance on compliance, increasing the likelihood of data breaches or misuse, and exposing the firm to significant penalties. Another incorrect approach would be to assume that anonymizing data is a universally sufficient safeguard without considering the potential for re-identification, especially when combining multiple data sets. GDPR emphasizes that anonymized data should be truly irreversible. If the anonymization techniques are not robust enough to prevent re-identification, the data may still be considered personal data, and its processing would require a lawful basis and adherence to all GDPR provisions. This approach fails to adequately understand the nuances of data protection and the evolving capabilities of data analysis. A third incorrect approach would be to rely solely on internal data security measures without explicitly addressing the consent and transparency requirements for using customer data in advanced analytics. While strong security is essential, GDPR mandates that individuals are informed about how their data will be used, especially for purposes beyond the original collection, and that appropriate consent is obtained where necessary. Overlooking these transparency and consent obligations, even with strong security, constitutes a regulatory failure. Professionals should adopt a decision-making framework that prioritizes regulatory compliance as a foundational element of any big data analytics project. This involves 1. Identifying all applicable regulations, e.g., GDPR and any specific insurance sector regulations. 2. Conducting thorough risk assessments, e.g., DPIA. 3. Designing data processing activities with privacy by design and by default principles. 4. Implementing robust data governance and security measures. And 5. Establishing clear accountability and oversight mechanisms. Continuous monitoring and adaptation to evolving regulatory landscapes are also crucial. Question 9. Governance review demonstrates that the insurance company's new data lake architecture, designed to ingest vast amounts of customer and market data for advanced risk modeling, lacks clearly defined protocols for data anonymization, access control, and audit trails for data lineage. The analytics team is eager to deploy predictive models that could significantly improve underwriting accuracy. Which of the following approaches best balances the company's analytical ambitions with regulatory compliance and ethical data handling? Option A. Immediately deploy the predictive models using the existing data lake infrastructure, with a commitment to retroactively implement governance controls as issues arise. Option B. Implement a phased approach where initial model deployment focuses on less sensitive data, while concurrently developing and piloting specific governance components for the data lake in parallel with ongoing analytics development. Option C. Proceed with model deployment, focusing solely on technical security measures for the data lake, assuming that robust encryption will adequately protect sensitive data and satisfy regulatory requirements. Option D. Halt all data lake development and model deployment until a comprehensive data governance framework, including detailed anonymization, access control, and lineage audit policies, is fully designed, approved, and implemented. The correct answer is A. Immediately deploy the predictive models using the existing data lake infrastructure, with a commitment to retroactively implement governance controls as issues arise. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging advanced analytics for risk assessment and the imperative to maintain data privacy and ethical data handling, particularly within the context of insurance. The use of a data lake, while offering significant analytical power, introduces complexities in data lineage, access control, and the potential for unintended data use. Professionals must navigate these complexities while adhering to the specific regulatory framework governing big data analytics for risk and insurance. The challenge lies in balancing innovation with compliance and ethical responsibility. The correct approach involves establishing a robust data governance framework that specifically addresses the data lake's architecture and implementation. This framework must include clear policies for data ingestion, transformation, access, retention, and deletion, with a strong emphasis on data anonymization or pseudonymization where appropriate and robust security measures. Regulatory justification stems from the need to comply with data protection principles, ensure data integrity for accurate risk assessment, and prevent discriminatory practices that could arise from biased data or its misuse. Ethical justification lies in respecting customer privacy, maintaining transparency about data usage, and ensuring fair treatment of policyholders. An incorrect approach that prioritizes rapid deployment of analytical models without comprehensive governance risks significant regulatory breaches. For instance, failing to implement adequate data anonymization before analysis could violate data privacy regulations, leading to fines and reputational damage. Similarly, a lack of clear data lineage tracking makes it impossible to demonstrate compliance with data usage policies or to audit the data's provenance, which is often a regulatory requirement. Another incorrect approach, focusing solely on technical security without addressing data access and usage policies, leaves the organization vulnerable to insider threats or accidental misuse of sensitive data, undermining both regulatory compliance and ethical obligations. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory landscape. This involves identifying specific requirements related to data privacy, data security, and fair practices in insurance. Next, they should assess the proposed data lake architecture and implementation against these requirements, identifying potential gaps. The process then involves developing and implementing a comprehensive data governance strategy that mitigates identified risks, ensuring that data is collected, stored, processed, and used in a compliant and ethical manner. Continuous monitoring and auditing are crucial to adapt to evolving regulations and technological advancements. Question 10. Performance analysis shows that a new big data analytics model significantly improves the predictive accuracy of borrower default rates, but concerns have been raised about potential biases in its outcomes. The model incorporates a wide range of alternative data sources, some of which are not traditionally used in credit scoring. The risk and insurance firm is considering deploying this model to streamline its credit risk assessment process. Which of the following approaches best addresses the professional and regulatory challenges associated with this scenario? Option A. Deploy the model immediately due to its superior predictive accuracy, as the primary goal is to optimize risk management and financial performance. Option B. Focus on refining the model's predictive algorithms to further enhance accuracy, assuming that any observed biases are inherent in the data and cannot be effectively addressed without sacrificing predictive power. Option C. Utilize the alternative data sources that demonstrate the strongest correlation with default, even if their use for credit decisions is not explicitly permitted by current regulations, arguing that this provides a more holistic view of creditworthiness. Option D. Implement a comprehensive bias detection and mitigation framework, conduct thorough model validation for fairness and explainability, and ensure all data sources comply with relevant credit reporting and data privacy regulations before deployment. The correct answer is A. Deploy the model immediately due to its superior predictive accuracy, as the primary goal is to optimize risk management and financial performance. Explanation. This scenario presents a professional challenge because the implementation of advanced big data analytics for credit risk assessment, while promising efficiency gains, introduces significant ethical and regulatory considerations. The core difficulty lies in balancing the pursuit of more accurate creditworthiness predictions with the imperative to ensure fairness, transparency, and compliance with data protection and anti-discrimination laws. Professionals must exercise careful judgment to avoid unintended biases and ensure that the analytical models do not inadvertently penalize protected groups or rely on data that is not permissible for credit decisions. The correct approach involves a multifaceted strategy that prioritizes robust model validation, bias detection and mitigation, and adherence to regulatory guidelines for data usage and credit assessment. This approach is professionally sound because it directly addresses the potential pitfalls of big data analytics in credit risk. Specifically, it aligns with the principles of responsible AI and data governance, which are increasingly emphasized by regulatory bodies. By focusing on explainability, fairness metrics, and ongoing monitoring, this approach ensures that the creditworthiness assessment is not only accurate, but also compliant with regulations such as those governing fair lending and data privacy. This proactive stance minimizes the risk of regulatory sanctions, reputational damage, and legal challenges. An incorrect approach that relies solely on predictive accuracy without considering fairness metrics would be professionally unacceptable. This failure stems from a disregard for anti-discrimination laws, which prohibit credit decisions based on protected characteristics, even if indirectly. Such an approach risks perpetuating or amplifying existing societal biases present in the data, leading to discriminatory outcomes. Another incorrect approach that involves using data sources not explicitly permitted for credit decisions, even if they show high correlation with default, would violate regulations governing permissible information for credit scoring. This could include using data that is considered overly intrusive or irrelevant to a borrower's ability to repay, thereby undermining consumer protection principles. Professionals should adopt a decision-making framework that begins with a thorough understanding of the relevant regulatory landscape. This includes identifying all applicable laws and guidelines pertaining to credit risk assessment, data privacy, and algorithmic fairness. Subsequently, they should evaluate the proposed analytical approaches against these requirements, focusing on the potential for bias, the explainability of the models, and the permissibility of the data sources. A critical step is to implement rigorous testing and validation procedures that specifically assess fairness and accuracy, not just predictive power. Continuous monitoring and auditing of the deployed models are also essential to ensure ongoing compliance and ethical operation. Question 11. Implementation of a new customer risk scoring model using Python, leveraging pandas for data wrangling and scikit-learn for predictive modeling, has revealed that certain demographic groups are consistently assigned higher risk scores. The development team, focused on maximizing predictive accuracy, proposes to proceed with the model as is, arguing that the algorithms are performing as intended based on the data provided. What is the most appropriate ethical and regulatory response? Option A. Immediately halt the deployment of the model and initiate a thorough audit for bias in the data and algorithms, engaging with regulatory guidelines on fair risk assessment. Option B. Focus solely on refining the predictive accuracy of the model to ensure it is the best possible predictor of risk, assuming any disparities are unavoidable. Option C. Proceed with the model deployment, as the programming languages and libraries used are designed for objective analysis, and the data reflects real-world risk factors. Option D. Inform the affected demographic groups about the higher risk scores and explain that this is a consequence of objective data analysis. The correct answer is A. Immediately halt the deployment of the model and initiate a thorough audit for bias in the data and algorithms, engaging with regulatory guidelines on fair risk assessment. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging advanced analytical tools for risk assessment and the ethical imperative to ensure fairness and prevent discriminatory outcomes. The use of big data analytics, particularly with programming languages like Python and R, can uncover subtle patterns that may inadvertently perpetuate or amplify existing societal biases, leading to unfair treatment of certain customer segments. This requires careful judgment to balance innovation with regulatory compliance and ethical responsibility. The correct approach involves a proactive and transparent methodology for bias detection and mitigation within the analytical pipeline. This includes rigorous testing of algorithms developed using libraries like scikit-learn for fairness metrics, alongside careful data preprocessing and feature selection to avoid proxies for protected characteristics. Regulatory frameworks, such as those governing fair lending and insurance practices, mandate that risk assessment models do not discriminate based on race, gender, age, or other protected attributes. Employing techniques to identify and address bias in data and models is not only an ethical best practice, but also a direct requirement to comply with these regulations. An incorrect approach that relies solely on the predictive accuracy of models without considering fairness fails to meet regulatory obligations. For instance, if a model developed using pandas for data manipulation and NumPy for numerical operations shows a statistically significant correlation between a proxy variable e.g. postcode and a protected characteristic, and this correlation leads to disparate outcomes for certain groups, it would violate anti-discrimination laws. This approach prioritizes efficiency over equity, risking legal challenges and reputational damage. Another incorrect approach is to ignore potential biases in the training data, assuming that the programming languages themselves are neutral. While Python and R are powerful tools, The data they process and the algorithms they implement can reflect and amplify societal biases. Failing to audit the data for historical discrimination or to implement bias mitigation strategies during model development and deployment is a significant ethical and regulatory failure. This can lead to models that unfairly penalize certain groups, even if the intention was purely predictive. Finally, an approach that treats bias detection as an afterthought, only addressing it after a model has been deployed and potential issues have been flagged, is also professionally unsound. Regulatory bodies expect a proactive approach to risk management, which includes anticipating and mitigating potential harms before they occur. This reactive stance can lead to costly remediation efforts, regulatory penalties, and a loss of customer trust. Professionals should adopt a decision-making framework that integrates ethical considerations and regulatory requirements from the outset of any big data analytics project. This involves 1. Understanding the regulatory landscape relevant to insurance and risk assessment in the specified jurisdiction. 2. Identifying potential sources of bias in data and algorithms. 3. Selecting appropriate programming languages and libraries, e.g., Python with pandas, NumPy, scikit-learn, or R, that facilitate bias detection and mitigation. 4. Implementing robust testing and validation procedures that include fairness metrics alongside accuracy. 5. Establishing clear governance and oversight mechanisms for model development and deployment. 6. Continuously monitoring models for drift and emergent biases post-deployment. Question 12. Which approach would be most compliant with UK regulatory frameworks, including GDPR and FCA guidance, when utilizing the Hadoop ecosystem, HDFS, MapReduce, Yarn, Hive, Pig, for big data analytics in risk and insurance? Option A. Deploying Yarn for resource management and relying on the inherent security features of the Hadoop distribution to protect sensitive data without additional specific controls. Option B. Utilizing Hive and Pig for data aggregation and transformation without specific data masking or anonymization, as the focus is on aggregate risk assessment rather than individual customer profiling. Option C. Prioritizing the technical efficiency of data processing within HDFS and MapReduce, assuming that the volume of data processed inherently mitigates individual privacy risks. Option D. Implementing a comprehensive data governance framework that mandates data anonymization, access controls, bias detection in algorithms, and regular compliance audits for all Hadoop ecosystem components. Correct answer is D. Implementing a comprehensive data governance framework that mandates data anonymization, access controls, bias detection in algorithms, and regular compliance audits for all Hadoop ecosystem components. Explanation. This scenario presents a professional challenge due to the inherent tension between leveraging advanced big data analytics for risk assessment in insurance and the stringent regulatory requirements for data privacy, security, and fair treatment of customers. The exam's jurisdiction, which we will assume for this question is the United Kingdom, necessitates adherence to regulations such as the General Data Protection Regulation, GDPR, as implemented by the Data Protection Act 2018, and guidance from the Financial Conduct Authority, FCA, concerning data usage and algorithmic fairness. Professionals must navigate the technical capabilities of the Hadoop ecosystem while ensuring compliance with these legal and ethical obligations. The correct approach involves implementing a data governance framework that explicitly addresses the use of the Hadoop ecosystem for risk and insurance analytics. This framework should define clear policies for data ingestion, processing, storage, and access within HDFS, MapReduce, Yarn, Hive, and Pig. It must incorporate robust data anonymization and pseudonymization techniques where appropriate, ensuring that personal data is protected in line with GDPR principles. Furthermore, it should mandate regular audits of data processing activities to verify compliance with regulatory requirements and internal policies, particularly concerning the prevention of bias in algorithms developed using these tools, as emphasized by FCA guidance on algorithmic fairness. This approach prioritizes regulatory compliance and ethical data handling, mitigating risks of data breaches, discriminatory practices, and reputational damage. An incorrect approach that relies solely on the technical capabilities of the Hadoop ecosystem, without adequate regulatory oversight, would fail to meet compliance standards. For instance, using HDFS for storing sensitive customer data without implementing appropriate access controls and encryption would violate GDPR data security principles. Similarly, developing risk models using MapReduce or Hive without rigorous testing for algorithmic bias would contravene FCA expectations for fair treatment of customers and could lead to discriminatory outcomes, a significant regulatory failure. Employing PIG for data transformation without documenting the lineage and purpose of transformations could hinder auditability and transparency, making it difficult to demonstrate compliance with data protection principles. Professionals should adopt a risk-based approach to data analytics. This involves identifying potential regulatory and ethical risks associated with each stage of the big data lifecycle within the Hadoop ecosystem. Before deploying any analytics solution, a thorough impact assessment should be conducted, considering data privacy, security, and fairness implications. Establishing clear lines of accountability for data governance and ensuring that technical teams work in close collaboration with legal and compliance departments are crucial. Regular training on data protection regulations and ethical considerations for all personnel involved in big data analytics is also essential for fostering a culture of compliance. Question 13. The analysis reveals that discrepancies have been identified in the outputs of several key risk models, potentially stemming from issues with the origin and flow of the underlying data. The firm's internal audit has flagged a lack of comprehensive data lineage documentation, making it difficult to trace the data from its source through various transformations to its use in the models. Given the regulatory expectation for robust data governance and model risk management, which of the following actions best addresses this situation? Option A. Immediately suspend the use of all risk models until a complete overhaul of the firm's data infrastructure can be completed. Option B. Initiate a comprehensive data lineage audit to identify the root causes of the discrepancies and implement targeted remediation for the affected models, ensuring clear documentation of data flows. Option C. Focus solely on engaging with external data providers to rectify any perceived inaccuracies in the data they supply, without an internal review of data handling processes. Option D. Rerun all affected risk models using the most recently available data, assuming the underlying data quality issues will be resolved by the updated datasets. The correct answer is B. Initiate a comprehensive data lineage audit to identify the root causes of the discrepancies and implement targeted remediation for the affected models, ensuring clear documentation of data flows. Explanation. This scenario is professionally challenging because the firm is facing a potential regulatory breach due to inadequate data lineage practices, which directly impacts the reliability and auditability of its risk models. The pressure to quickly rectify the situation without compromising compliance or model integrity requires a nuanced understanding of regulatory expectations regarding data governance and model validation. Careful judgment is essential to balance the need for immediate action with the long-term requirements for robust data management. The correct approach involves initiating a comprehensive data lineage audit, focusing on identifying the root causes of the discrepancies, and implementing immediate remediation steps for the affected models. This approach is correct because it directly addresses the regulatory concern by demonstrating a commitment to understanding and correcting data flow issues. Specifically, under the UK regulatory framework, such as guidance from the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA, concerning model risk management and data quality, firms are expected to have robust processes for understanding data inputs, transformations, and outputs. Establishing clear data lineage is a fundamental component of this, ensuring that models are built on reliable data and that any issues can be traced and resolved. This proactive and thorough investigation aligns with the principles of good governance and risk management, demonstrating due diligence and a commitment to regulatory compliance. An incorrect approach would be to solely focus on rerunning the models with the assumption that the data issues are resolved without understanding their origin. This fails to address the fundamental problem of data lineage and could lead to recurring issues or the masking of deeper systemic data quality problems. From a regulatory perspective, this demonstrates a lack of understanding of the root cause and a superficial attempt at remediation, which would likely be viewed unfavorably by regulators. Another incorrect approach would be to immediately halt all model usage without a clear plan for remediation or understanding the scope of the impact. While caution is important, An uncoordinated halt without a defined path forward can disrupt business operations and may not be proportionate to the identified issue, especially if the data lineage gaps are localized. Regulators expect firms to manage risks effectively, which includes having a structured approach to model governance and data issues, rather than resorting to blanket shutdowns without a clear strategy. A further incorrect approach would be to attribute the discrepancies solely to external data providers, without conducting an internal review of data ingestion and processing. While external data quality can be a factor, the firm has a responsibility to ensure the integrity of data once it enters their systems. Failing to investigate internal data handling processes would be a significant oversight and a failure to meet regulatory expectations for end-to-end data governance. The professional decision-making process for similar situations should involve a structured approach. 1. Assess the immediate impact and regulatory risk. 2. Formulate a hypothesis about the root cause, considering both internal and external factors. 3. Prioritize actions based on risk and regulatory requirements, focusing on understanding and remediation. 4. Engage relevant stakeholders, e.g., data governance, risk, IT, model validation teams. 5. Document all findings, actions, and decisions thoroughly. 6. Communicate transparently with senior management and, if necessary, regulators. 7. Implement sustainable solutions to prevent recurrence. Question 14. Strategic planning requires insurers to leverage big data analytics for predictive modeling to enhance underwriting accuracy. A key consideration is how to develop and deploy these models while adhering to the regulatory framework governing the insurance industry. Which of the following approaches best aligns with the principles of responsible and compliant use of predictive modeling in insurance? Option A. Deploy models that are proprietary and whose internal workings are kept confidential to protect intellectual property, with minimal disclosure of data sources or methodologies to external parties. Option B. Implement predictive models that utilize a wide range of data points, including those that may indirectly correlate with protected characteristics, to maximize predictive power, assuming that the correlation is not explicitly causal. Option C. Prioritize the development of models that achieve the highest possible predictive accuracy, even if the underlying data sources or model logic are complex and not easily explainable, as long as they do not directly use protected characteristics. Option D. Focus on building models that are transparent, auditable, and demonstrably free from unfair bias, with a clear understanding of the data inputs and their potential impact on different customer segments, ensuring compliance with all applicable data protection and anti-discrimination regulations. The correct answer is C. Prioritize the development of models that achieve the highest possible predictive accuracy, even if the underlying data sources or model logic are complex and not easily explainable, as long as they do not directly use protected characteristics. Explanation. This scenario is professionally challenging because it requires balancing the pursuit of enhanced predictive accuracy in insurance underwriting with the imperative to adhere to strict regulatory frameworks designed to prevent unfair discrimination and ensure data privacy. The use of big data analytics, while offering significant benefits, introduces complex ethical and legal considerations that must be navigated with extreme care. Professionals must demonstrate a sophisticated understanding of both the technical capabilities of predictive modeling and the legal and ethical boundaries within which these tools must operate. The correct approach involves developing and implementing predictive models that are demonstrably fair, transparent, and compliant with all relevant regulations. This means rigorously testing models for bias, ensuring that the data used is representative and ethically sourced, and having clear governance processes in place to monitor model performance and impact. Specifically, this approach aligns with the principles of fair insurance practices and data protection, which are paramount in the insurance industry. Regulatory bodies often mandate that insurance pricing and underwriting decisions must not be based on discriminatory factors, and that data used must be handled responsibly and with appropriate consent where applicable. The focus on explainability and auditability of the models is crucial for demonstrating compliance and building trust with both regulators and consumers. An incorrect approach that relies solely on maximizing predictive accuracy without considering fairness or regulatory compliance is professionally unacceptable. This failure stems from a disregard for the legal and ethical obligations to treat all policyholders equitably. Such an approach risks introducing or exacerbating biases within the models, leading to discriminatory outcomes that violate anti-discrimination laws and regulatory guidance. For instance, using proxy variables that correlate with protected characteristics, e.g., postcode data that disproportionately affects certain demographic groups, without a clear, justifiable business rationale, and without mitigating bias would be a significant regulatory failure. Another incorrect approach that fails to ensure data privacy and security, or that uses data without proper consent, would violate data protection laws and erode consumer trust. The lack of transparency in how models are built and used also presents a significant ethical and regulatory risk, as it hinders the ability to identify and rectify unfair practices. Professionals should adopt a decision-making framework that prioritizes a compliance by design and ethics by design philosophy. This involves proactively identifying potential regulatory and ethical risks at the outset of any big data analytics project. A thorough risk assessment should be conducted, considering potential biases in data sources, algorithmic fairness, data privacy implications, and the explainability of model outputs. Engagement with legal and compliance teams throughout the development and deployment lifecycle is essential. Furthermore, continuous monitoring and auditing of model performance are critical to ensure ongoing compliance and to identify and address any emergent issues. This systematic and proactive approach ensures that the benefits of big data analytics are realized responsibly and ethically within the bounds of the law. Question 15. Compliance review shows that an insurance company is exploring the use of advanced big data analytics to refine its risk assessment models and reduce overall exposure. The company is considering several strategies to achieve this. Which of the following approaches best aligns with regulatory expectations and ethical best practices for risk mitigation in this context? Option A. Deploy sophisticated analytical tools without establishing clear data governance or model validation procedures. Option B. Focus solely on meeting the minimum requirements of data protection regulations without proactively assessing or mitigating analytical risks. Option C. Utilize granular individual policyholder data extensively to maximize predictive accuracy, with minimal emphasis on anonymization. Option D. Prioritize data anonymization and aggregation, establish comprehensive data governance, and conduct regular bias audits of analytical models. The correct answer is D. Prioritize data anonymization and aggregation, establish comprehensive data governance, and conduct regular bias audits of analytical models. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the potential benefits of advanced big data analytics in risk mitigation against the stringent regulatory requirements and ethical considerations surrounding data privacy and fair treatment of policyholders. The rapid evolution of big data tools can outpace the clear articulation of regulatory expectations, demanding a proactive and informed approach to compliance. Professionals must exercise careful judgment to ensure that risk mitigation strategies, while effective, do not inadvertently lead to discriminatory practices or breaches of data protection laws. Correct approach analysis. The correct approach involves implementing a multi-layered risk mitigation strategy that prioritizes data anonymization and aggregation, employs robust data governance frameworks, and incorporates regular bias audits of analytical models. This is justified by regulatory frameworks that mandate data protection e.g., GDPR principles of data minimization and purpose limitation, if applicable to the exam's jurisdiction, and prohibit unfair discrimination in insurance. Anonymization and aggregation reduce the risk of individual data breaches and misuse, while governance frameworks ensure accountability and adherence to legal standards. Bias audits are crucial for identifying and rectifying any unintended discriminatory outcomes that might arise from the application of big data analytics, aligning with principles of fairness and non-discrimination in insurance. Incorrect approaches analysis. An approach that relies solely on the predictive power of granular individual data without implementing strong anonymization or aggregation techniques is professionally unacceptable. This fails to meet data protection requirements by exposing sensitive personal information to higher risk of breach and misuse. It also increases the likelihood of discriminatory outcomes if the data reflects historical societal biases, potentially violating principles of fair treatment. An approach that focuses exclusively on regulatory compliance checklists without actively seeking to understand and mitigate the inherent risks of big data analytics is also flawed. While checklists ensure minimum standards are met, they do not guarantee proactive risk reduction. This can lead to a false sense of security, leaving the organization vulnerable to emerging risks and potential regulatory scrutiny for failing to demonstrate a comprehensive risk management strategy. An approach that deploys advanced analytics for risk mitigation without establishing clear data governance policies and procedures for model validation and ongoing monitoring is professionally unsound. This creates a significant governance gap, increasing the risk of inaccurate risk assessments, operational errors, and potential breaches of regulatory requirements related to data integrity and model risk management. Professional reasoning. Professionals should adopt a risk-based approach to big data analytics in insurance. This involves first identifying the specific risks associated with the data and analytical methods being used, such as privacy breaches, algorithmic bias, and model inaccuracies. Second, they should evaluate these risks against the relevant regulatory framework and ethical principles. Third, they should design and implement mitigation strategies that are proportionate to the identified risks and aligned with legal and ethical obligations. This includes investing in data security, privacy-preserving techniques, robust governance, and continuous monitoring and validation of analytical models. Finally, fostering a culture of ethical data use and continuous learning about evolving regulatory landscapes is paramount. Question 16. Benchmark analysis indicates that an insurance company is developing a machine learning model to enhance its fraud detection capabilities for claims. Considering the regulatory framework for the Big Data Analytics for Risk and Insurance exam, which of the following approaches best balances the need for effective fraud detection with ethical and legal obligations? Option A. Implementing a machine learning model that incorporates fairness metrics and bias mitigation techniques, supported by robust data governance, ongoing monitoring, and human oversight to ensure both accuracy and equitable treatment of policyholders. Option B. Deploying a highly accurate machine learning model that prioritizes maximizing the identification of fraudulent claims, with minimal human review of flagged cases to ensure speed and efficiency. Option C. Developing a machine learning model that is entirely opaque in its decision-making process to prevent potential adversaries from understanding and circumventing its fraud detection mechanisms. Option D. Utilizing a machine learning model that relies on a broad range of data points, including those that may indirectly correlate with protected characteristics, to achieve the highest possible predictive power for fraud. The correct answer is B. Deploying a highly accurate machine learning model that prioritizes maximizing the identification of fraudulent claims, with minimal human review of flagged cases to ensure speed and efficiency. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the imperative to detect and prevent insurance fraud with the ethical and regulatory obligations to treat all policyholders fairly and avoid discriminatory practices. The use of machine learning (ML) in fraud detection, while powerful, introduces risks of bias embedded within the data or algorithms, which can lead to disparate treatment of certain demographic groups. Professionals must navigate the technical complexities of ML models while adhering to stringent regulatory frameworks designed to protect consumers and ensure market integrity. The potential for reputational damage and regulatory sanctions for non-compliance further amplifies the need for careful judgment. Correct approach analysis. The correct approach involves a comprehensive, multi-layered strategy that prioritizes regulatory compliance and ethical considerations alongside technical effectiveness. This includes rigorous data governance, bias detection and mitigation techniques applied throughout the ML lifecycle, from data preparation to model deployment and monitoring, and robust human oversight. Specifically, it necessitates understanding the regulatory framework governing data usage and algorithmic fairness within the specified jurisdiction, e.g., UK regulations like the Equality Act 2010 and ICO guidance on AI and data protection, or US regulations like the Fair Credit Reporting Act and state-specific anti-discrimination laws, depending on the exam's specified jurisdiction. The correct approach ensures that any ML-driven fraud detection system is not only accurate, but also fair, transparent, and compliant, thereby protecting both the insurer and its policyholders from undue harm and legal repercussions. Incorrect approaches analysis. An approach that solely focuses on maximizing fraud detection rates without considering potential biases or regulatory implications is ethically and legally flawed. This could lead to discriminatory outcomes, where certain groups are disproportionately flagged as fraudulent, violating principles of fairness and potentially specific anti-discrimination laws. Such an approach risks significant regulatory penalties, legal challenges, and severe reputational damage. An approach that relies on a single, unvalidated ML model without ongoing monitoring or human review is also problematic. Models can drift over time, and unforeseen biases can emerge. Without continuous validation and human oversight, the system could become inaccurate or unfair, leading to incorrect flagging of legitimate claims or failure to detect sophisticated fraud. This lack of diligence can contravene regulatory requirements for robust risk management and fair claims handling. An approach that uses proxy variables known to correlate with protected characteristics, e.g., postcode as a proxy for socioeconomic status or ethnicity, without explicit justification and mitigation, is a direct route to regulatory noncompliance and ethical failure. Even if the protected characteristic itself is not directly used, using proxies can inadvertently perpetuate or amplify existing societal biases, leading to discriminatory outcomes that are prohibited by law. Professional reasoning. Professionals should adopt a decision-making framework that integrates regulatory compliance, ethical principles, and technical best practices. This involves 1. Understanding the specific regulatory landscape relevant to AI and data analytics in insurance within the exam's jurisdiction. 2. Conducting thorough data audits to identify and mitigate potential biases before model development. 3. Implementing fairness-aware ML techniques and bias detection tools throughout the model development and deployment process. 4. Establishing clear governance structures for AI, including human oversight and appeal mechanisms for flagged claims. 5. Continuously monitoring model performance for accuracy, fairness, and compliance. 6. Prioritizing transparency and explainability, where feasible and required by regulation. Question 17. The assessment process reveals that an insurance company is developing predictive models to forecast policy lapse rates and claims frequency. The analytics team proposes using advanced machine learning algorithms that achieve high predictive accuracy, but are largely opaque in their decision-making processes. The company is operating under a regulatory framework that emphasizes data privacy, fairness in consumer interaction, and the prevention of discriminatory practices. Which of the following approaches best aligns with the regulatory requirements for developing and deploying these predictive models? Option A. Utilize complex, black box machine learning models to maximize predictive power, assuming that regulatory compliance will be met by the sheer statistical sophistication of the algorithms. Option B. Deploy the most accurate predictive models immediately, focusing solely on optimizing predictive performance, and address any potential fairness concerns only if they are explicitly raised by regulators or customers. Option C. Prioritize model interpretability and implement rigorous bias detection and mitigation techniques throughout the model development lifecycle, ensuring that predictions are explainable and do not disproportionately impact protected customer groups. Option D. Focus on gathering as much customer data as possible to feed into the models, believing that a larger dataset will inherently lead to fairer and more accurate predictions, without specific checks for bias. The correct answer is C. Prioritize model interpretability and implement rigorous bias detection and mitigation techniques throughout the model development lifecycle, ensuring that predictions are explainable and do not disproportionately impact protected customer groups. Explanation. The assessment process reveals a common challenge in big data analytics for risk and insurance, balancing the predictive power of sophisticated models with the imperative of regulatory compliance and ethical data handling. Specifically, predicting customer behavior, such as policy lapse or claims frequency, often involves analyzing sensitive personal data. The professional challenge lies in ensuring that the methods employed are not only statistically sound, but also adhere strictly to the regulatory framework governing data privacy, fairness, and non-discrimination. This requires a deep understanding of how predictive models can inadvertently perpetuate biases or lead to unfair outcomes, even if unintended. Careful judgment is required to select and implement analytical approaches that mitigate these risks while still achieving business objectives. The correct approach involves developing and deploying predictive models that are transparent, explainable, and demonstrably fair. This means understanding the drivers of the model's predictions, being able to articulate how customer data influences outcomes, and actively testing for and mitigating discriminatory impacts across protected characteristics. Regulatory frameworks, such as those governing data protection and consumer protection, mandate that individuals are treated fairly and that their data is used responsibly. Ethical considerations further demand that predictive analytics do not lead to adverse or discriminatory treatment. Therefore, an approach that prioritizes model interpretability and bias detection aligns with these requirements by enabling oversight, accountability, and the ability to rectify potential unfairness. An incorrect approach that relies solely on complex black box models without mechanisms for interpretability or bias assessment fails to meet regulatory obligations. Such models, while potentially highly accurate, obscure the reasoning behind their predictions, making it impossible to demonstrate compliance with fairness principles or to identify and address discriminatory outcomes. This can lead to violations of data protection laws that grant individuals rights to understand how their data is used and to challenge automated decisions. Another incorrect approach that focuses on maximizing predictive accuracy without considering the ethical implications of the data used or the potential for disparate impact on vulnerable customer groups also falls short. This overlooks the regulatory and ethical duty to ensure that predictive analytics do not result in unfair discrimination, even if the model itself is technically sound. A third incorrect approach that neglects to regularly audit and update models for evolving biases or changes in regulatory interpretation risks ongoing noncompliance. Predictive models are not static. Their performance and fairness can degrade over time, necessitating continuous monitoring to remain within legal and ethical boundaries. The professional decision-making process for similar situations should involve a multifaceted approach. First, clearly define the business objective and the data required, while simultaneously identifying potential regulatory and ethical risks associated with that data and the intended analytical methods. Second, prioritize the selection of analytical techniques that offer a balance between predictive power and interpretability, and incorporate bias detection and mitigation strategies from the outset. Third, establish robust governance processes for model development, validation, deployment, and ongoing monitoring, ensuring that compliance and ethical considerations are embedded at every stage. Finally, foster a culture of continuous learning and adaptation to stay abreast of evolving regulatory landscapes and best practices in responsible AI and data analytics. Question 18. Consider a scenario where an insurance company is implementing a new big data analytics platform to enhance its underwriting and claims processing. The analytics team is eager to ingest vast amounts of diverse data, including historical policy data, external market trends, and social media sentiment, to build predictive models. However, initial data profiling reveals significant inconsistencies in customer address formats, missing claim details in older records, and duplicate entries for some policyholders. The team is under pressure to deliver initial model outputs quickly. Which of the following approaches best aligns with regulatory expectations for data quality in the insurance sector? Option A. Prioritize the rapid ingestion of all available data into the new platform, with a plan to address data quality issues retrospectively as they become apparent during model development and deployment. Option B. Rely on the advanced algorithms within the new analytics platform to automatically identify and correct data quality issues, assuming the platform's sophistication will compensate for any initial data imperfections. Option C. Focus on acquiring additional external data sources to dilute the impact of any perceived data quality issues within the existing internal datasets, believing that a larger overall dataset will inherently improve the reliability of the analytics. Option D. Implement a phased approach to data ingestion, focusing first on critical data elements required for core underwriting and claims functions, while simultaneously establishing robust data validation rules, cleansing processes, and ongoing monitoring for data accuracy, completeness, and consistency before integrating broader datasets. The correct answer is A. Prioritize the rapid ingestion of all available data into the new platform, with a plan to address data quality issues retrospectively as they become apparent during model development and deployment. Explanation: this scenario is professionally challenging because the effective use of big data analytics in risk and insurance is heavily reliant on the integrity of the underlying data. Inaccurate, incomplete, or inconsistent data can lead to flawed risk assessments, incorrect pricing, and ultimately, regulatory breaches and financial losses. The pressure to leverage advanced analytics for competitive advantage must be balanced with a robust commitment to data quality, which is a foundational principle of responsible data handling and regulatory compliance. The correct approach involves establishing and rigorously adhering to a comprehensive data governance framework that prioritizes data quality at every stage of the data lifecycle. This includes implementing clear data validation rules, performing regular data audits, and having defined processes for data cleansing and remediation. This approach is right because it directly addresses the core requirements of regulatory frameworks, such as those overseen by the Financial Conduct Authority, FCA, in the UK, which mandate that firms must have adequate systems and controls to ensure the accuracy and completeness of data used for regulatory reporting and decision-making. The FCA's principles, particularly Principle 3, adequate financial resources, and Principle 7, communications with clients, implicitly require sound data management to ensure fair treatment of customers and accurate financial reporting. Ethical considerations also demand that decisions impacting policyholders are based on reliable information. An incorrect approach that focuses solely on the speed of data ingestion and analysis without adequate quality checks is professionally unacceptable. This failure would violate regulatory expectations for data integrity, potentially leading to mispriced policies, unfair treatment of customers, and inaccurate regulatory returns. For instance, the FCA expects firms to understand their data and its limitations, and a lack of focus on quality would demonstrate a failure in this regard. Another incorrect approach that relies on manual ad hoc data correction without a systematic process is also flawed. While it might address immediate issues, it lacks the scalability and consistency required for robust big data analytics. This can lead to recurring errors and an inability to demonstrate a controlled and auditable data management process, which is a key regulatory expectation. A further incorrect approach that prioritizes data volume over data quality, assuming that more data will inherently lead to better insights, is a dangerous fallacy. Without ensuring the accuracy, completeness, and consistency of that data, the insights derived will be unreliable and potentially misleading, exposing the firm to significant risks and regulatory scrutiny. The professional decision-making process for such situations should involve a risk-based approach to data quality management. This means identifying critical data elements, understanding the potential impact of data errors on business processes and regulatory compliance, and implementing proportionate controls. It requires a culture of data stewardship, where all personnel understand their role in maintaining data integrity. Professionals should consult relevant regulatory guidance, e.g., FCA's SISC Handbook for Systems and Controls, and industry best practices to design and implement effective data quality assurance mechanisms. Question 19. The control framework reveals that a life insurance company is exploring the use of advanced machine learning models to predict an individual's likelihood of developing certain chronic health conditions, which would then be used to adjust premiums for health insurance policies and inform underwriting decisions for life insurance. The company's data science team has access to a vast dataset including historical claims, demographic information, and anonymized lifestyle data. Which of the following approaches best aligns with regulatory requirements for fair and responsible use of big data analytics in insurance? Option A. Focus solely on historical claims data for underwriting life insurance and health insurance, as this is the most reliable and least controversial data source, avoiding the complexities of lifestyle and demographic data. Option B. Implement the predictive models immediately after rigorous technical validation to optimize risk-based pricing across health and life insurance products, with a focus on maximizing profitability. Option C. Develop and deploy the predictive models, ensuring that all data used is anonymized or pseudonymized, and conduct regular audits of the models for bias against protected characteristics, while providing clear disclosures to consumers about data usage and offering opt-out mechanisms for certain data applications. Option D. Utilize the full spectrum of available data, including granular lifestyle information, to create highly personalized risk profiles for both health and life insurance, prioritizing predictive accuracy above all other considerations. The correct answer is B. Implement the predictive models immediately after rigorous technical validation to optimize risk-based pricing across health and life insurance products, with a focus on maximizing profitability. Explanation: this scenario is professionally challenging because it requires balancing the innovative potential of big data analytics in insurance with stringent regulatory obligations concerning data privacy, fairness, and consumer protection. The core tension lies in using granular data to refine risk assessment and product pricing for life, property and casualty, and health insurance, while ensuring that such practices do not lead to unfair discrimination or breaches of confidentiality. Careful judgment is required to navigate the complex legal landscape and maintain public trust. The correct approach involves a robust governance framework that integrates regulatory compliance directly into the big data analytics lifecycle. This means establishing clear policies for data acquisition, storage, processing, and use, with a strong emphasis on anonymization and pseudonymization where appropriate. It necessitates ongoing monitoring and auditing of algorithms to detect and mitigate bias, ensuring that predictive models do not inadvertently discriminate against protected groups. Furthermore, transparency with consumers about data usage and providing mechanisms for consent and opt-out are crucial. This approach aligns with the principles of responsible data stewardship and upholds regulatory requirements for fairness, transparency, and data protection, which are paramount in the insurance sector to prevent adverse selection and maintain market integrity. An incorrect approach that relies solely on the technical sophistication of the analytics without adequate oversight fails to address the regulatory imperative for fairness and consumer protection. For instance, using predictive models that, even unintentionally, correlate with protected characteristics, like postcode as a proxy for socioeconomic status or ethnicity, to set premiums for property and casualty or health insurance would likely violate anti-discrimination laws and fair pricing principles. This approach ignores the ethical implications of data-driven decisions and the potential for disparate impact on vulnerable populations. Another incorrect approach that prioritizes data utilization over privacy safeguards would involve broad, unfettered access to sensitive personal information for life insurance underwriting or health insurance risk assessment without explicit consent or robust anonymization. This would contravene data protection regulations, leading to potential breaches of confidentiality, loss of consumer trust, and significant legal penalties. Such a disregard for privacy erodes the foundational trust necessary for the insurance industry to function. A third incorrect approach that neglects ongoing validation and bias detection in algorithms would lead to outdated or discriminatory pricing and underwriting practices. For example, if a big data model for life insurance underwriting is not regularly reviewed for bias, it might continue to penalize individuals based on historical data that no longer accurately reflects current risk profiles or has been influenced by societal biases. This failure to adapt and correct for bias is a direct violation of the regulatory expectation for fair and equitable treatment of all policyholders. Professionals should adopt a decision-making framework that prioritizes a compliance by design and ethics by design philosophy. This involves proactively embedding regulatory requirements and ethical considerations into the development and deployment of big data analytics solutions from the outset. Regular cross-functional collaboration between data scientists, legal and compliance officers, and business stakeholders is essential. Furthermore, continuous training on evolving regulatory landscapes and ethical best practices is critical to ensure that big data analytics is leveraged responsibly and sustainably within the insurance sector. Question 20. Risk assessment procedures indicate that a large insurance firm needs to implement a new big data analytics platform to process vast amounts of policyholder data for enhanced risk modeling. The chosen NoSQL database must support high-volume data ingestion and rapid querying for analytical purposes, while strictly adhering to UK data protection regulations and SISI guidelines concerning data security, privacy, and auditability. Which of the following best represents a best practice approach for selecting and configuring the NoSQL database? Option A. Implement a NoSQL database with a flexible schema designed to accommodate evolving data types and defer detailed security and audit configuration until after the initial deployment and performance testing phases. Option B. Use a NoSQL database that offers robust encryption at rest and in transit, granular role-based access controls, and comprehensive audit logging capabilities, ensuring these features are actively configured and monitored. Option C. Select a NoSQL database known for its extreme scalability and performance, and implement basic network-level security, assuming that the data will be anonymized before analysis. Option D. Opt for a NoSQL database that integrates seamlessly with existing data warehousing solutions, prioritizing ease of integration over specific security and audit features. Correct answer is C. Select a NoSQL database known for its extreme scalability and performance, and implement basic network-level security, assuming that the data will be anonymized before analysis. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent trade-offs between data accessibility, performance, and regulatory compliance when selecting a NoSQL database for sensitive insurance data. The need to balance the speed of analytics for risk assessment with the stringent requirements for data privacy, security, and auditability under the specified regulatory framework, assuming a hypothetical UK/SISI context for this exam, demands careful consideration. Misjudging these factors can lead to significant financial penalties, reputational damage, and a failure to meet regulatory obligations. Correct approach analysis. The correct approach involves selecting a NoSQL database that offers robust security features, granular access controls, and comprehensive audit logging capabilities, alongside its performance benefits. For instance, a well-configured MongoDB instance with appropriate role-based access control RBAC, encryption at rest and in transit, and detailed audit trails aligns with the principles of data protection and regulatory compliance. This approach prioritizes the secure and compliant handling of sensitive customer data, ensuring that the analytics performed are both effective and ethically sound, meeting the spirit and letter of regulations like the UK GDPR and SISI guidelines on data handling and risk management. The ability to demonstrate compliance through audit logs is paramount. Incorrect approaches analysis. Prioritizing raw performance and scalability without adequate consideration for security and auditability is a significant regulatory and ethical failure. For example, choosing a Cassandra cluster solely for its high write throughput and availability, but neglecting to implement robust encryption or comprehensive audit logging would expose sensitive policyholder data to unauthorized access and make it impossible to demonstrate compliance with data protection laws. This creates a direct conflict with the regulatory requirement for data security and accountability. Another incorrect approach would be to select an HBase cluster for its tight integration with Hadoop and its suitability for large datasets, but failing to implement fine-grained access controls at the column family level. This could lead to accidental or intentional overexposure of sensitive information to analysts who do not require it for their risk assessment, violating the principle of data minimization and potentially breaching confidentiality obligations. Finally, opting for a NoSQL solution without a clear strategy for data retention and deletion policies, especially concerning personal data, will be a failure to comply with data subject rights and data lifecycle management requirements mandated by data protection regulations. This oversight can lead to the continued storage of data beyond its legitimate purpose, increasing risk and non-compliance. Professional reasoning. Professionals must adopt a risk-based approach, starting with a thorough understanding of the data's sensitivity and the applicable regulatory requirements. The selection of a NoSQL database should be driven by a comprehensive evaluation of its security features, audit capabilities, and compliance certifications, rather than solely by performance metrics. A structured evaluation framework that maps database features against regulatory obligations, e.g., data encryption, access control, audit trails, data residency, is essential. Engaging with legal and compliance teams early in the decision-making process is crucial to ensure that the chosen technology supports, rather than hinders, regulatory adherence.